Have you ever wondered how to make the most of your money through smart investments? Join us on a simplified journey where we'll break down the best order for investing your money, making it easy to grasp even for beginners. Number 1. Build an emergency fund. The concept of an emergency fund goes beyond just setting aside money for unforeseen circumstances. Think of it as a fiscal shield, a protective barrier between you and financial disaster. While investments and debt repayment have their merits, an emergency fund is your fortress against life's unexpected curveballs. Imagine a sudden medical expense, a car breakdown, or a job loss. Situations that could plunge you into debt if you're not prepared. This fund acts as a safety net, giving you the financial breathing room to weather storms without spiraling into debt. Determining the optimal size of your emergency fund is akin to tailoring a suit. It should fit you perfectly. Factors like monthly expenses, dependents, and income come into play. While there's no one-size-fits-all rule, a general guideline suggests saving enough to cover 3 to 6 months' worth of expenses. However, bear in mind that while your emergency fund is safeguarded against immediate needs, it might not be shielded against the erosive effects of inflation. The larger the fund, the greater the risk of inflation gradually eroding its real value over time. To strike a balance, consider exploring low-risk options such as the brokered CD ladder, which presents the potential for returns while minimizing inflation's impact. Number 2. Pay off credit card debt. Credit card debt is like a persistent leak in your financial boat. The high interest rates, often exceeding 20%, can quickly balloon what you owe, causing a steady drain on your financial resources. The interest on credit card debt can easily surpass any investment gains you might make. Picture this: you have a choice between investing or paying off credit card debt. The calculations clearly demonstrate that directing your resources toward debt repayment is the more financially advantageous path. By freeing yourself from the clutches of credit card debt, you're positioning yourself to fully harness the potential of your investments, unencumbered by the burden of high-interest liabilities. Number 3. Pay off other high-interest debt. As you tackle credit card debt, extend your attention to other high-interest obligations, like student loans or debts with interest rates between 6% and 10%. This might seem counterintuitive, considering the allure of potentially higher investment returns. However, consider this as priming the soil before planting the seeds. By eradicating these high-interest debts, you're creating fertile ground for your investments to grow. It's akin to clearing the path before embarking on a journey. The financial resources that would otherwise be funneled into servicing these debts can now be redirected into investments, fostering the growth of your financial portfolio. Number 4. Pay off low-interest debt. Turning your focus to debt again, albeit of a different nature. The objective is to target debts with interest rates ranging from 4% to 5%. While it might seem logical to allocate your resources toward investments promising higher returns, it's important to recognize that eliminating this type of debt guarantees you a rate of return that's relatively consistent. This can have a tangible impact on your long-term financial health, especially during periods of market volatility, when traditional investments might yield unfavorable returns. By chipping away at these debts, you're laying a stable financial foundation that can withstand the unpredictable shifts of the market. Number 5. Take full advantage of your 401k employer match. Your 401k employer match is a financial gift that keeps on giving. Imagine a scenario where someone matches the money you put into your retirement account. This is a rare instance where your investment grows instantly. It's akin to doubling your money as soon as you invest it. Even if your employer matches a percentage of your contribution, the cumulative effect over time can be substantial. By capitalizing on this match, you're essentially supercharging your retirement savings. This is akin to your employer actively participating in your retirement planning, helping you accumulate funds that can potentially make your post-work life much more comfortable. Before we continue, make sure to give us a thumbs up by hitting the like button and subscribe to our channel for more valuable insights. Your support keeps us going. Now, let's dive back into the action. Number 6. Max out your health savings account or HSA. Imagine an accountant that acts as a dual-purpose financial tool, simultaneously offering tax advantages and health-related benefits. That's precisely what a health savings account (HSA) provides. Maxing out your contributions isn't just about putting aside money for medical expenses. It's about optimizing your tax strategy. Your contributions are tax-deductible, reducing your taxable income. Moreover, qualified medical expenses withdrawals are completely tax-free. This makes HSAs a financial twofer, a smart way to build a healthcare cushion while also minimizing your tax burden. The beauty of an HSA doesn't end with your active working years. It morphs into an invaluable resource in your retirement toolkit. Any funds left unused for medical expenses roll over, continuing to grow tax-deferred. Once you retire, these remaining funds transform into an ordinary individual retirement account or IRA, allowing you to leverage them for your post-work life. In 2023, the contribution limits for HSAs are $3,650 for individuals and $7,300 for families, with a $1,000 additional contribution allowed for those aged 55 and above, similar to catch-up contributions for IRAs and 401ks. This blend of immediate tax benefits and future financial security makes maxing out your HSA a judicious move. Number 7. Max out your IRA. The allure of an individual retirement account or IRA lies in its flexibility and cost efficiency. Unlike some 401k plans, IRAs provide you with a broader spectrum of investment options and typically involve lower fees. Corporate 401k plans can lean heavily on mutual funds with higher management costs, while IRAs grant you access to cost-effective exchange-traded funds or ETFs. Collaborating with a financial advisor can be a game-changer, helping you identify the most economical investment products and construct a tax strategy that encompasses both traditional and Roth IRAs. Focusing on your IRA empowers you with greater control over your retirement funds, potentially augmenting your future financial standing. Number 8. Finish maxing out your 401k. After maximizing your IRA, it's time to redirect your attention back to your 401k. What sets this retirement avenue apart is its generous contribution limits and the absence of income caps. Compared to IRAs, which have a limit of $6,500, with a $7,500 catch-up option for those over 50, 401ks offer substantially higher contribution ceilings. In 2023, you can channel up to $22,500 into your 401k, a significant difference. This considerable room for contribution amplifies your capacity for tax-advantaged retirement savings, effectively turbocharging your retirement readiness. Number 9. Fund taxable investment accounts. As you progress in your financial journey, you'll reach the stage where funding taxable investment accounts comes into focus. These accounts, such as brokerage accounts, offer a diversified range of investment options, from stocks and bonds to ETFs and mutual funds. While the allure of handpicking individual stocks might be tempting, it's generally wiser to opt for diversified ETFs and mutual funds. These vehicles provide a safer, more risk-mitigated approach, reducing the potential volatility associated with single stock investments. Furthermore, these securities are tax-efficient, subject to lower long-term capital gains tax rates. Number 10. Pay off your mortgage. Maybe. Contemplating your mortgage strategy is an integral part of your overall financial plan. If you secured your mortgage during a period of historically low interest rates, retaining it could be a prudent move. The concept here hinges on inflation working in your favor. Over time, inflation can effectively reduce the real value of the debt you owe. In parallel, your investments in the stock market hold the potential to outpace the interest rate on your mortgage. This dynamic presents a scenario where your investments might yield a more favorable return compared to the interest accruing on your mortgage. However, This strategic decision requires careful consideration of your financial landscape and objectives. You've reached the end of our investing journey. Congrats! We hope you had a blast learning new things. Here's a fun challenge for you. What's the first investment you're excited to try? Share your answer in the comments. We're all ears. If you enjoyed this ride, give us a thumbs up by hitting like. And if you haven't already, subscribe and ring the bell so you don't miss our next exciting adventure. Remember, your financial journey is just starting, and we're here to help. Keep investing and keep smiling.